It is Friday, the 17th of April. Welcome to our 6th session of your Guide Through the Storm. I'm Bob Simpson, your host for these webinars. I'm joined today by Paul Tyers, a regular panelist, and Vern Vippel, in-house legal counsel for Wealth Stewards. Vern is originally from Winnipeg, so he is enjoying the snow in mid-April. He's a lawyer by trade. He attended law school at University of Manitoba many years ago. He only, in his bio, he only said many. After graduating from law school, he moved to Toronto, completed a Master's of Taxation, worked in a tax group at McCarthy Tetro, and then a boutique tax firm. Most recently, he was a partner at KPMG and KPMG Law in Toronto. While at KPMG, his major focus was tax dispute resolution, which is effectively representing companies through the CRA audit process, which starts from the initial notification that a company is under audit all the way to the formal trial at the Tax Court of Canada. Now, as a point of order, in your Zoom control panel, there is a Q&A button. We try to keep these sessions to 20 minutes or so to respect your time, but we're happy to take your calls at the end to answer any questions that you might take. Please, if you have a question, please type your questions in your control panel. There's a Q&A button. Just simply please type your questions in there and we'll be pleased to answer them. Now, let me take a minute to review the previous sessions. This is the 6th one. In week 1, we're in the worst part of the storm, and we addressed stock market volatility and the importance of sticking with longer term plans. In week 2, we discussed your core satellite approach and the importance of reviewing your risk tolerance during difficult times like we've been experiencing. In week 3, we looked back at previous market declines and how markets recovered. And we discussed some of the initial changes that portfolio stewards are making in our portfolios. Week 4, we started a shift from dealing with the market declines and the upset of such to looking for opportunities in the private debt and equity markets. And in week 5, we first discussed some of the upcoming changes to the portfolios to better position us for the next 1 to 2 years. And then we had Michelle Follows from Estate Stewards join us to help people who felt they had some time on their hands to look at their estate documents and their programs and to get them updated. And during that session, she also offered a 30-minute estate review. So if you want to take advantage of that, please get in touch with us and we'll be glad to set you up with these. Now, all of these sessions are recorded. And you can view them by going to the portfoliostewards.ca, where there's a link right there on the homepage, and you can go back and listen to any of the previous sessions that we've done. Now that brings us to week 6, and we're going to be continuing with our theme of searching for opportunities during periods of turmoil. Vern joins us to discuss tax loss harvesting, which is a method of taking advantage of losses incurred in your taxable portfolios due to COVID-19 pandemic. Now, before that, let's take a quick look at the storm to see how it's playing out. In Canada, COVID-19 new cases grew by 51% over the past week. And while that's still a really big number, it's well below the 250 and 500% readings that we're getting a couple of weeks ago. And I only mention this to, we're all looking for some hope as to when we're going to be able to get our lives back to normal again. Now, looking at market performance, the TSX Composite this week dropped 1.89%, and that is as of yesterday's. The next slide will show you a bit more updated. The SP 500 is up 0.35%. That brings those two markets to -18 and -13. And you can see on the left that the moderate conservative balanced and moderate growth portfolios have all fared much better than those markets. Now, if we look and, talking about the storm, this is what we've identified as the storm, the 4-week period where, markets just were in strong downtrends. Since then, I call this the recovery, where we've had a 10.2 week, we've had 11.47 week, we had a little bit of a downtick in the second week, and this week we're up about 1.77%. So we've had a pretty good recovery so far. Now, that is not to say that we will not see some further weakness. We may see a revisit of the storm. These two charts show you on the left the S&P 500, and you can see there that we've recovered. We got as low as negative 33%. We're now at negative 16. So that's about a 50% retracement of the decline. And the TSX composite got as low as 37%. It's recovered to around the 21.4 range. So again, about a 50% retracement of that decline. Now, one thing just, and this is a point of education, I guess, for you, is that Amazon, Apple, and Microsoft, these three companies, they make up 15.2% of the S&P 500. They also make up 34% of the NASDAQ 100. So when you're listening to the news and they're talking about the S&P 500 or the NASDAQ and how they're performing, they are largely influenced by these three companies. They are large companies with strong balance sheets and competitive advantage. So it's not really surprising that Amazon has returned this year 27%. People are not able to shop in the stores. They're buying at Amazon. Microsoft, they have the new Microsoft 365, where you can buy the Office products and pay monthly. That's really helped their earnings. Apple's down a little bit at 4%, but all three of them have performed much better than the broad market at negative 11% as we move forward. So what I'd like to do now is I'm going to turn our attention over to our guest panelist, Vern. And I'd like to start, Vern, you off with a question that everybody is asking. So number one, are you ready for this, Vern? You ready?
Absolutely, Bob.
Yep. With all the stimulus packages that are being provided by the federal and provincial governments and the massive deficits that we were experiencing going in, how are the governments going to pay for these programs? Now, just before we do that, we want to encourage your questions. So if this is something that you believe you are interested in getting the answer to, click the Q&A button and type yes. So Vern, I'll turn it over to you. And what are your thoughts related to that?
Thanks, Bob. So many of you have at least seen in part some of Prime Minister Trudeau's daily briefings around midday each day, where he gives an update as to Canada, how Canada is doing with the COVID epidemic, and he announces government initiatives to help both consumers and businesses. And I believe to date, probably been over $100 billion worth of relief that's been announced so far, and we're not even done yet. Because there will likely be more relief from the federal government that will be announced in the upcoming weeks and months. And I think we can all agree that it's a very large number, but it's sometimes difficult to put this number into perspective. So Canada's national debt before the crisis began was just under $800 billion, and that's our total accumulated national debt. And for 2020, this year it's estimated that Canada will be in a deficit position of more than $180 billion. And so that represents over 20% of our total national debt. So that's just a large amount for Canadians to take on in only 1 year. So Bob, as you said, a question becomes, well, how does the federal government pay for all these initiatives? And it has been announced there will be quantitative easing in the issuance of government bonds, and effectively this will mean the printing of more money, but it's also widely understood that this is not going to be enough. The government needs to come up with more ways to increase revenue and increase funding. So I haven't heard any official announcements yet, but it's expected that the government will need to look at other avenues to increase its revenues. One of those avenues will definitely be to increase its tax revenue. Now, it's common knowledge that with any announcement to an increase in income tax rate, such as the marginal tax rate, if those go up, there are bad announcements for politicians, and they probably will hurt any politician's chances of re-election. So it's become more common in recent years to attempt to or try to expand the tax base by making changes to certain tax rules rather than just increasing the marginal or other tax rates. So, an example is perhaps a couple of years ago when it was announced that the small business deduction for Canadian corporations would be grinded down for any corporations that had investment income that generated more than $50,000 per year. And this was an announcement that did make a lot of headlines. However, one practice that does not typically make headlines is the aggressiveness and the frequency of CRA tax audits. So in the last few years of the Harper government, it was determined, pursuant to an internal government study, that for every $1 that was invested by CRA in their audit activities, it resulted in more than $7 of revenue. So this led a few years ago to an increased budget for CRA audit activities, and this ultimately includes substantial investment in CRA's computer software and algorithms to determine who will be selected for an audit, as well as the hiring of more CRA auditors. So in my experience working in the tax dispute resolution side, hiring more auditors meant there were new auditors that weren't well trained, and also situations where a CRA was taking an overly aggressive and frequently incorrect audit position that it likely would not have taken place a few years prior. So the reality is that Canadians need to understand that CRA is set up as a business, just like how other or regular companies meet and come up with strategies to generate revenue for that company. Similarly, CRA meets regularly and they come up with strategies to generate more revenue for the Canadian government. So now with COVID-19, the Canadian government will be forced to come up with more revenue to cover the extensive deficit in 2020, and they will be putting increased pressure on CRA to generate some of those revenues. But it gets to be a bit of a cycle, because if Canadians and Canadian companies are not generating as much taxable revenue as has been done in the past, and the CRA will be forced to effectively put more pressure on its audit activities. So what's going to happen is that more Canadians will see both themselves and their businesses being audited for income tax more frequently, and also being assessed for taking tax positions that perhaps were not an issue or perhaps were not audited on in prior years. So what does this really mean for Canadians going forward? Well, I think there should be more focus in setting up one's finances to be the most tax efficient as possible, but also make sure the Canadians are 100% compliant with all the tax rules when doing so, and to also minimize any room for potential gray areas, so that CRA cannot take an aggressive position and issue any income tax assessments for tax owing. So the bottom line is that it's going to be important for Canadians to get their tax planning done right, and to do so right from the beginning.
Right, so Fern, one thing that I've noticed recently is that my pants have been feeling tight, and I thought maybe I was putting some weight on, but it was because the government had their hands in my pockets, and instead of just in one, they're in two, which made them feel a little bit tight. So it sounds like more hands in our pockets moving forward. Now, we invited you today to discuss the topic of tax loss harvesting, based on the market activities that we're experiencing. Is this a strategy that can be used to help investors to reduce their upcoming tax burden?
Absolutely, Bob. It is effective, and I believe it's a strategy that a lot of investors either don't know about or do not take the time to implement in their overall investment strategy. So now, naturally, no one ever wants to take a loss on any investment. The reality is in 2020 that some investments are going to be worth less than their original purchase price. And for some of these investments, investors will want to simply just stay put until the valuation goes back up. There might be some tax planning advantages, ultimately financial value in taking advantage of the loss in the valuation. And this is where tax loss harvesting comes in. So the concept of tax loss harvesting is simple. It's effectively selling an asset for a capital loss in order to offset any taxable gains. So the background behind this is that the gain in the value of any capital asset, this could be in shares of a company or units of a fund, or even units of an ETF, are generally only taxed on their disposition or sale. So if an investor has a capital gain from the sale of one investment for which they would be required to pay capital gains tax on, the investor may wish to purposefully trigger a capital loss by selling an asset that has gone down in value from its purchase price, so that the capital loss can effectively offset the capital gain that's reported for tax purposes.
Can you give us an example of how tax loss selling might work?
Absolutely. So if you could turn to the next slide, Bob, and we have a graphic here. So in an example whereby an investor has units of Fund A, and say, for example, they've paid $20,000 for these units, and those units have gone up to $30,000, and they have a $10,000 capital gain. Well, there's a 50% tax. All capital gains are taxable at 50%. There's assuming a 50% marginal tax rate, that investor would pay $2,500 of tax. So the investor would net $7,500. However, if an investor also has units of Fund B, say, for example, it paid $10,000 for the units in Fund B, and those units are now worth $7,000, that effectively is a capital loss of $3,000. Well, for the same year, the investor can take advantage of that tax loss by an offset the capital gain of the units of Fund A. And in this example, if it's a $10,000 gain of units of Fund A and a $3,000 loss of units of Fund B, that would net out to $7,000, which would be $1,750 of tax owing. So ultimately, this would end up with a savings of $750. So one particular advantage, however, for tax loss harvesting is that the capital loss does not have to take place in the same year as the capital gain. So by way of background, a capital tax loss cannot be offset with regular business income, employment income. There has to be a capital gain in order to take advantage of a capital loss. But capital losses can be carried back up to 3 years and can also be carried forward indefinitely. So going back to the example, if the investor sold units in Fund A in 2017 and had a capital gain, which the investor paid income tax from filing its 2017 tax return, the investor could now in 2020 trigger a capital loss on the decrease in valuation of Fund B and effectively carry that capital loss back to 2017 and get a partial refund of some of the tax originally paid in 2017. So in the example here, the tax savings of $750 could apply in 2020, provided there was a sufficient gain incurred in 2017 or a later tax year. So I also wanted to highlight that even though there's no, this also applies to situations where there's been no capital gain in the last 3 years. And in these situations, the investor may want to consider still triggering a capital loss now in 2020 to offset any future capital gains where there would be tax, because any capital losses can be carried forward indefinitely for any future tax year. So going back to the example again, assume that the investor has not yet sold any units in Fund A and does not have any taxable capital gains in the prior 3 years. So here the investor may still wish to sell units in Fund B to trigger capital loss in 2020. And then if it chooses to sell units in Fund A at a later date in 2022, for example, 2 years from now, the investor will have less income tax to pay in 2022, as it can use a capital loss from Fund B to offset the taxable capital gain from Fund A in 2022. So the bottom line here is that investors should take a proactive approach today to try to minimize any future tax liabilities. And one last comment I wanted to make on taking a review of an investor's portfolio is that quite frequently ends up being December that most investment advisors review any potential for tax loss harvesting. And the reason being is that the disposition has to take place before December 31st of each year in order to take advantage of the tax loss for that year. However, this year in 2020, the circumstances are slightly different. The valuation today in April of 2020 of certain investments are likely going to be less than in December when the markets are expected to rebound. So therefore, unlike other years, it may be best for investors to review their portfolio today to take advantage of tax loss harvesting rather than waiting until December, as is typically done in other years where there may not be as large of a loss to claim.
Okay, so I just want to go off script for a sec. And Paul, can you unmute for a sec?
Yes, I can.
Yeah. So Vern, thanks for going through the example of that. Now, when somebody deals with a discretionary portfolio manager like yourself, how do you do? What is the role of the investor, and what's the role of the discretionary manager when it comes to issues like tax loss harvesting?
Well, historically, it would be a November exercise for us to start turning our focus to this. It has to be very situation specific, because we will have some people who, for example, the capital gains and losses haven't necessarily been in their portfolio, but there could have been a capital gain that occurred on the sale of a business or some real estate. And so this is where our business model of collaborating with our client's CPA is essential to be able to put those pieces together and make sure that we are optimizing an individual circumstances. So yes, we have our discretion to look what's in front of us, but it is essential for us to do the full job of collaborating with somebody's outside investments as well, which typically will be better known by the CPA that they deal with.
Right. Okay, so that's awesome. Now back to you, Vern. What are the mechanics to actually carry back or carry forward a capital loss? And does that mean that you need to do an amended income tax return and have that filed before carrying back or prior?
Yeah, that's right. That's a good question, Bob. So all tax losses must be reported in the same year that the loss is actually incurred. So if an investment is sold in 2020, then it needs to be reported on the 2020 income tax return. However, if carrying the losses back to a prior tax year, say for a gain that had been incurred in 2017, then a Form T1A, which is called a request for loss carryback form, would be filed in 2020, effectively in the year that the loss is incurred. So there would be no need to file an amended return going back to 2017 in that example.
Okay, so what happens if you can you just sell a security and buy the same one back? Or what if you sell a security and buy something really similar to the one that you have? For example, if units that invest in a certain asset class are purchased, would that be subject to the superficial loss rules?
Right. Yes. So that's a good question, Bob. So superficial loss rule is a rule that prevents an investor from taking advantage of tax loss harvesting by buying the same asset within 30 days. So the impact of this rule is that the investor would not be able to offset the capital gain for capital loss, whereby the same asset that triggers the loss is repurchased within 30 days of the sale. So going back to the example of the investor sold Fund A and trigger a capital gain, and then sold Fund B to trigger capital loss, but then the investor would not be allowed to offset the gain if it repurchased the unit in Fund B within 30 days from the date of the original sale. So these are known as the superficial loss rules. It's effectively a tax avoidance rule. And I also want to note that the investor spouse, it's not just the investor, but the investor spouse can also not repurchase that same asset within 30 days. Now, to answer your question in more detail, Bob, there is an issue that may arise as to, well, what is considered to be the same asset? So in general, the rule is that in order for these, or in order for a superficial loss rule to apply, it generally needs to be the identical asset. So if, for example, the investor has units in a fund that's focused in a particular sector, for example, the oil industry, and it sells units in that fund to trigger capital loss, well, pursuant to the superficial loss rules, the investor cannot repurchase units in that exact same fund within 30 days. But the investor can purchase units in a similar fund or competing fund that's also focused on the same industry. So, for example, the oil industry here. And so this will allow an investor to still continue to have exposure to that particular market or industry in their portfolio. Now, while I say so, there is an exception to CRA and CRA's policy with respect to index funds, whereby a different index fund is purchased within 30 days, but where that index fund tracks the exact same index, and CRA's position is that here it effectively would be considered the same asset for purposes of the superficial loss rules. So, one other item I wanted to mention on the tax loss harvesting rules is that there's an exception to the advantage of these rules where the investment is in the form of a tax shelter, such as an RSP or a TFSA, where the gain on that investment would not be subject to tax. So, for example, if there's a loss in the valuation of a particular investment that's held for an RSP, there would be no benefit in using the tax loss harvesting rules of the capital loss cannot be used to offset any taxable gains. And this is because any gains on the losing investment would not have been subject to tax if there was a gain.
So, Vern, I also heard that through some of the recent announcements, and one of the things that people have found is that people are not spending their whole days watching the weather network. They can now watch the COVID-19 channels on CBC and whatever. But I hear through some of the announcements that there's going to be some extensions for the filing of income tax returns this year. Is that correct?
Yes, that's right, Bob. So the Canadian government, CRA, have announced extensions to some of the regular reporting and payment due date for income taxes. So for individuals, the general filing due date and payment date is April 30th of each year. But for individuals, it's been announced that the revised filing date is June 1st of this year, and the payment date for any taxes, if there's any taxes owing, would be September 1st. And September 1st date also includes situations whereby there's installment payments that are made and extension for the regular June 15th installment payment would now be extended to September 1st. Now, I do note that generally for individuals who have self-employment income or business income, the income tax due date is generally June 15th of each year. And so far, the CRA has not yet announced any extensions to the filing due dates of those returns. So again, if you've got self-employment income or business income, proceed for now with the assumption that June 15th will remain the due date. Now, for corporations, the filing due date and the final payment date for any taxes owing is generally 6 months from the corporation's fiscal year end. So the Canadian government here has announced that for corporations with a filing date after March 18th, but before June 30th of this year, the filing due date has been extended to June 1st. And the payment date for any payments required has been extended to September 1st of 2020, and applying to corporations with a filing due date between March 18th and before June 1st.
Okay.
And lastly, I do want to highlight that there are revised filing dates and payment dates for trusts. And also there's certain information that is required to be provided to CRA throughout the year. And there's certain elections that a taxpayer may want to make. And there have been some extensions to various elections and information returns as well that have been announced.
Okay, I just want to turn the question back to Paul for a sec, and then we'll address again. If you have any questions, just use the Q&A. Please type it in. We've got a couple of questions. I just wanted to run something by Paul again, and that is, so as a portfolio manager, one of the things that you're looking at doing is tax loss harvesting. In a market environment like this, are there some other things that you're looking at right now when your investment committee meets with regard to the investment portfolios, other than just selling and buying back the same thing?
Absolutely. As a matter of fact, we have, over the last couple of weeks, we've identified certain securities that we wanted to purchase in what we call a recovery portfolio. But first we had to identify which securities we wanted to discard. And so we've made one fairly significant change this week, and that is to sell a large position that we had in most clients' portfolios in the international business, the international securities. And there was a couple overlapping reasons for doing that. There was an opportunity to tax loss harvest, but we do feel that there is a bit of a deglobalization trend going on. And as a result, we think that there's going to be less buoyancy in some of the international markets. And we're replacing that with securities that have a global reach. These are fortress balance sheet companies, well-respected and strong companies in individual sectors. So there was an example where we could sell one security, realize a loss, and by virtue of replacing it with some of these other individual securities, we don't run afoul of the superficial loss rules. So that's an example of an integration of the two strategies at once.
Right, so you're really, Paul, combining a review of the investments and the managers of those investments right now to see how those managers or investments have been performing and whether they've met the standards that you're looking for. And if they haven't, then you're looking at this as an opportunity to improve the quality of the portfolio. Is that what you're saying?
That's exactly right. And we have certainly, as we go into the next week, we set our sights this week on really the international markets, and we took some action. But we believe that next week we already have identified an area, and that is in the real estate sector, that we are hopeful that we can really, we've got some research going on as we speak to really identify some opportunities there that may also cross over between both the tax loss harvesting opportunity and a change in the portfolio, a fundamental change in the portfolios.
Okay, and I keep clicking on wrong buttons here. I apologize for that. Just checking to see if we have any questions in the Q&A, and it doesn't appear as though we have, but we've kind of gone on a little longer than we'd like to. Give it a minute or so if anybody has any questions. And if not, what I would like to do is I would like to thank Paul and Vern, especially Vern as a guest, for joining us today and taking us through some examples of how we can be opportunistic during difficult markets like we're experiencing. And a question just popped up. Thank you. Can you please send us the past recordings? And once again, the easiest way to do that is to, and let me just back up in the presentation here. If we go right back to the beginning, if you go to portfoliostewards.ca and right down at the bottom, are you looking for a guide through the storm? Click here and all of the recordings are there. That's easier for you to access the ones that you wish than us sending it out. Another question that we just got in, and thanks for the questions. Are these tax strategies being implemented automatically for Wealth Stewards clients? I take that over to Paul.
I wouldn't say automatically. I would say that there are some that are pretty logical because we can make one change in a portfolio, but we are communicating with clients on these and often with the CPA as well, because as I mentioned, sometimes there are additional activities that have gone on in people's lives, quite apart from the portfolios, that have to be brought to bear in a situation like this. So it's really a combination. Some of them are automatic in the portfolio. Some of them go beyond the portfolio given individual circumstances.
Yeah, so what a good way to respond to that is they're not being done automatically, but they're being done systematically.
That's a fair summation.
Mm-hmm. Okay. All right. And I think right now, I think that deals with the questions we've had. Thanks for sending them over. We appreciate it. And once again, thanks for joining your guide through the storm. And we will continue this. At some stage, as things normalize, we'll probably reduce the frequency of these meetings from weekly to bi-weekly. But at this stage, we want to make sure that we have the lines open for you in case there is some further upset in markets, that will be there for you. You don't have to wait a couple weeks. So we'll be running them weekly, but at some stage we'll probably be switching them to every other week until we get through the storm. So thanks, Vern, for joining us. Thanks, everybody else, and have a lovely weekend.
Thank you, and bye for now.